Now it is over to you. Professor Godbole.
Thank you so much. First of all, good afternoon. Thank you, Mr. Nandagopal. Thank you, Dr. Ramesh, for this brief introduction. And thank you, AIMS, for giving me this opportunity to address to the participants and to enlighten them about the current status of insurance in India. And of course, when we say India, India is the world today. So we will take an overview of the world scenario. We will try to find out what happens in India. And then we will also try to get your queries or your questions answered. As I was introduced, thank you for that introduction. I belong to a reinsurance company in India and had an opportunity to actually see insurance sector across so many other countries also. Plus, thanks to the friends like Dr. Ramesh and others, that I was continuously associated with academics for last about 20-25 years. And this gives me a lot of pleasure to connect with you. I would just begin with the first slide. The importance of insurance in economic activities has been recognized for many years. The impact of insurance on economy was mentioned by United Nations Conference on Trade and Development, UNCTAD, in 1964, where it was highlighted that a sound national insurance and reinsurance market is an essential characteristic of economic growth. Now, if we can look at it carefully, we will see the timing is such that during that time, many of the colonies were becoming independent states. And then it was required that while all these new countries, new economies prosper, they should pay attention to this aspect of insurance and reinsurance. And that is why this very bold statement made in UNCTAD in 1964 itself. There is a positive relationship between development of insurance market, size, and the economic growth. A resilient and well-regulated insurance industry can significantly contribute to economic growth and efficient resource allocation. Now, not deviating too much from the subject, but because I said I'm associated with the academics also for a large number of years, along with my career in the insurance industry, I do not see many researchers actually doing research in this particular area, and I would urge that some of you should take that up to find out what is the correlation or causal relationship between insurance and the economic growth. While I can find a number of papers on the other financial services, especially banking, but in insurance, not much has been done is what is my feeling. And I thought that while I address students, while I address faculty members and all others, I should make this mention that there is a good scope to do research on this particular topic. Can we move to the next one? Insurance not only facilitates economic transactions through risk transfer and indemnification, but is also seen to promote financial intermediation. More specifically, insurance can have effects such as promoting financial stability, mobilizing savings, facilitating trade and commerce, enabling risk to be managed more efficiently, encouraging loss mitigation, fostering efficient capital allocation, and also be a substitute for government-funded security programs. So this I'm saying is we probably have been looking at insurance to be only relating to what kind of life insurance individuals should be buying and what kind of the other health and car insurances that we should be buying. But there is a bigger canvas. There is a lot more than the insurance industry does. So insurance provides safety and security to the insured and the family members. So this is very, very important that a bread earner has been having the responsibility of running his family, and he has certain plans for future, and therefore some kind of some finances to fall back on are necessary, which will come from insurance. Insurance provides protection against future risk, accidents, and uncertainty. So this is why we all know that we know driving a car. but we still buy insurance because we do not know whether our mistake or someone else's mistake we could still meet with an accident, or simply crossing a road is what we have been taught from the school days. But then there is no guarantee. There is always an uncertainty that I may cross the road safely or I may not. Insurance promotes financial stability and reduces anxiety. Now, here also a lot of projects and kind of industries would otherwise be under a lot of stress unless the kind of support of insurance was available to them, because you just do not know which day there could be some damage in the industry, there could be flooding, there could be some other calamity that will occur. Insurance enables risk to be managed more efficiently. Now, here the point is actually in relation to two things. One is the law of large numbers, because rather than managing your risk alone, there will be many similar exposures bundled together, and therefore the efficiency will go up. And the other side of it is that the professionalism. Rather than individuals or the industries managing their own risks, if it is handed over to experts, which are the insurance companies, the efficiency would go up. Insurance also facilitates trade and commerce the same way as I explained just now, because apart from manufacturing and all that, there is a lot of movement of goods also happening across the country, across the nations, and here also the support through the kind of marine cargo insurance, etc., is useful. Insurance mobilizes savings and channelizes into investment. Now, this is also one very important thing, and maybe some of us realize it when we look at the annual accounts or the balance sheet of Life Insurance Corporation of India as to what are the funds under management by a single insurance company. But of course, our industry was opened up for competition only about a decade back, and therefore the other companies do not hold similar kind of portfolios in the market. However, it is very important to note that 40% of the top 100 fund managers, I repeat, 40% of the top 100 fund managers of the world are actually insurance companies. So that is the role it also plays, and that is the role it plays into the financial sector of the economy as well. Can we move ahead? So basically, insurance involves taking care of risks. How is the global risk scenario if we would like to look at it? A report of World Economic Forum of the year 2020, and this report came out, I think, before the pandemic began. So it is titled actually as Global Risks Dash Out of Control. Now, this is a very kind of unique title to this report. The report mentions that trade relations are worsening. Population growth puts pressure on water and food security. Increasing old age population create issues of managing social security schemes. Multilateralism is under threat, which affects global stability and creates new cross-border challenges. Due to climate change, water levels are rising, weather patterns are changing. World has seen changes and challenges created by new and revolutionary biotechnologies, but I think we have seen the risks of those technological improvements also. And vulnerability of critical physical and technological infrastructure have been a security concern due to terrorism and cybercrime. So this is a very unique report which talks about a lot of urbanization happening, world population growing up, putting pressure on natural resources, and also kind of highlighting the polarization and weak governance, which raises serious questions about many countries' political health. So I would say that yes, a lot of research happens in the world, and if this report was of a year 2020, we are in the year 2023, and we see a lot of it relevant and very relevant today when we see what is happening all over the world. So I repeat that there is a strong relationship between the risk and insurance. Can we move ahead? There is another kind of top risk report again of 2020, the year 2020. It reads as, in the coming weeks, the world will get a much better handle on the coronavirus pandemic, but the weakness of the geopolitical order in terms of the legitimacy of domestic politics, the weakness of existing international alliances, and the lack of alignment of institutional frameworks reflect a radically different backdrop for global crisis than any we have experienced in recent decades. Now, unlike the earlier report, this report was published when the pandemic was showing kind of its results. Of course, at that time, it was not known when everything will be over and the world will be back to normal. But still, it was mentioned that it's not going to be only the coronavirus pandemic, but there are going to be many more risks. Now, when we talk of the risks in all these dimensions, there is one more institution which keeps talking about it, taking a lot of what we can say is research into it and asking people question and then generating the results out of it. And that is actually the World Economic Forum, which comes out with the Global Risk Report. Now, move to the next one. This is something that is available. I would say that many of you would have already visited these reports of the World Economic Forum called as risk reports. They are published every year. They have a lot of information with respect to the risks actually bundled into the environmental risks, the geopolitical risks, societal risks, economic risks, and technological risks. But the slide that we are seeing right now in front of us, it actually shows that these risks are not only the kind of risks that would affect us in silos, but there is a lot of interconnection between these risks also. So here we are seeing the larger dots and the colored dots, some of them showing the risk relating to geopolitical tensions, some of them showing the kind of societal problems, some of them showing the technological risk, and actually the web that is being shown by connecting the dots is that it is not necessary that the risks will operate in silos. So when we talk about risk and risk management, the today's world looks at risk in a larger perspective, and we call it as enterprise wide risk management. So enterprise risk management, the crux of which is this, that one, it is not sufficient to look into the risks into the individual boxes, but it is important to find out what are the connections and interlinkages between different risks. Otherwise, you will be facing a lot of unpleasant surprises. Next one. So this is again coming out of the World Economic Forum risk report. And as we can see, there are color codings and there is a list of risks that are being shown. On the left hand side, these are the top 10 risks, and on the right hand side, the risk moving from 11 till 20 are being shown. This kind of pattern is being released by World Economic Forum each year, and of course, depending on the changes in the global external environment, the numbers keep dwindling. Now here we can see that the latest report shows green color risk as a major risk among the top 10. And if we see the coding, it is the environmental risk that is being expected to be making larger losses. And that is where we see that a lot of news we hear is that there is going to be a very strong heat wave, or certain areas saw a lot of rain and flooding. which was once sometime back that had happened only 50 years back, but now it is recurring almost every year. Or then we hear about the glaciers melting, and all these things are related to the environmental risk. And that is why, if we are looking at this particular chart, 1, 2, 3, 4, 5 out of 10 are in the green color. However, the first one is on societal risk. There is another red at 5 and 10 also. And then there is a geopolitical risk shown on number 3. When it comes to 11 till 20, and one thing we must always remember is that every risk has its reference to the economic side of the financial side of it. So 11, 12, 13 and 18, 17 are being shown as blue color, which are talking about the risks in the economic zone. So these are some kind of benchmarkings. Now, why are they important? They are important because they are important to us as normal human beings. They are important to the insurance industry because a lot of these things are affecting insurance industry. If insurance industry works basically on the kind of analysis of the past ratios, it is, as I said, a game of collecting premium from many who are fortunate and paying claims of a few unfortunate people. So, all that working will go haywire if the external environment changes very fast. So, if a particular premium calculation was done on a particular statistical basis, saying that the flooding in Chennai city may happen once in 20 years, and now Chennai or Bangalore sees the flooding happening every alternate year, then this is going to affect the insurance industry also, because it has a relevance on the claims payment, and then based on the claims performance, the premium will be charged and the premium naturally will be hiked. So we'll move to the next one. Having said that risk is at the core when we are talking of risk management and insurance, basically people look at risk differently, because there are also some factors that we have to remember, that some people are kind of risk takers, some are risk averse people, they do not like to take risk, and some are risk neutral, they are not sure how they will respond to the risk. One day they respond in a different way, the other day they respond in a different way. But whatever is this background, actually it makes a lot of sense to put all our risk exposures into a matrix. This matrix is called as a risk matrix, and it is a matrix putting every risk into the matrix of impact on one axis and likelihood on the other axis, would help us decide as to how to take care of the risk. So we are seeing in this particular slide down below the matrix and likelihood and impact being shown on the two axes. We will see that risk is such that today this program was scheduled, and what is the likelihood that Mr. Deepak Godbole is not able to address to the participants? Now, this is the risk because the program will have to be called off. Now, if we try to find out what is the likelihood that this doesn't happen, actually we are on a virtual platform. So it is taking care of even the risks of Deepak Godbole flying from, say, Mumbai to Hyderabad to address the participants, and maybe there is some problem with the airlines or something like that, or there is flooding in Hyderabad, or nothing like that is there. So the likelihood of my not being available at 3 o'clock for this particular speech is absolutely negligible, absolutely low. Whereas, what would be the impact? At best, if I am not going to be available because of some other very, very, very pressing kind of work that would suddenly come up, I have number of other speakers and alternatives available, whom I would definitely make a request, because otherwise more than 100 people are interested in knowing about this particular subject. So the impact of this will also be very negligible. So this particular thing will end up into the left hand side bottom green area, and the risks that go into this particular area are very, very insignificant or negligible. So we may live with those risks or we may ignore those risks. Now, talking of the other extreme, if we look at the right hand side top corner, which is red, maybe we say that insurance is for uncertainties. We cannot insure something which we know what is going to be the outcome. So now we have all heard about Bermuda Triangle, and I mean, I'm just saying we have heard about it, and people say that if any aircraft or any ship passes through that, there is a strong likelihood that it will be sucked in and the cargo will be lost. Now, if that is the theory, and we say that we are going to send our cargo from Jawaharlal Nehru Port to a port in USA, and the route will involve this particular location, then what is the likelihood that the cargo will be lost? It will be the highest likelihood. Whereas what would be the impact? The impact will be total, because the cargo will be totally lost. Now this risk will go and end up into that right hand top corner red, and actually we should not encounter with such risks in any way. One should not send the cargo in that particular route, and the insurance companies will not also allow insurance to be given to this particular transaction. Now that leaves us to the middle, where we are saying that insurance is for uncertainty, and something, as I told you, that I drive a car. What is the likelihood that I meet with an accident? I may or I may not, maybe once in 2 years. And what is the impact? Impact may be that the two cars dash on each other because of the sudden braking by a car, and therefore maybe the car may be repaired and it can be put to use again. Now, all such risks will fall in the middle, and these are actually the potential risks which can be insured. So I would say that this is a very, very simple technique to put all our risk and risk exposures into the risk matrix, and it will tell us how to take care of these risks. The next one. Okay, it is good to know certain words and terms in appreciating risk management and insurance. Insurance companies are in the business of risk management, so it involves carrying out a plan to deal with the potential losses. Now, as I said, the first word that we should be looking at is peril. And the meaning of peril is the cause of loss. Now, peril has a very important meaning in insurance, because the cover that we get from the insurance company is to protect us from the defined perils. So the insurance cover or the policy that is given to us will mention that this cover is going to be for these perils. For example, we heard some time back about the crop insurance. So maybe there is a crop insurance policy, and it will mention that this policy covers the following perils. And the perils will be listed as flooding, maybe listed as drought, maybe listed as fire, and only those listed perils, for only those listed perils, the claim will be entertained. Now, that is why understanding of peril is very, very important in insurance, because many of the claims that go into litigation are because of the misunderstanding. The insured feels that he is covered for a particular peril, and the insurance company says that this was an excluded peril. The next word we should know would be hazard. Okay, so hazard actually is a condition. Now, it can also be said a condition that could lead to a loss situation. Okay, the hazard, physical hazard. Now, physical hazard is simply the explanation, if I can give you, is if we are driving a car which was punctured 3 times in the last month and we have not bothered about changing the tire or the tube, then it is a big physical hazard. Or if we are having a factory in which there is a boiler and we are also storing some material which can catch fire in the next room, but there is no foolproof fireproof partition in between, then that is physical hazard. The next type of hazard is the moral hazard, and moral hazard is something to do with the human beings. Okay, it's something to do with the human beings with an intention to do something wrong, with the help of the insurance cover taken. So there are many such cases where the claims are not genuine, and these are the cases of moral hazard. For example, there could be an industry which was doing well in its product, but now the technology has changed and people's preferences have changed, and therefore the product doesn't get sold. And some very smart people may feel that I'll put my factory on fire and all the stock will be lost and I will claim it from the insurance company. But when insurance investigation proves that this fire was not a natural fire and this was because of the moral hazard, someone thought of making or misusing insurance, this particular loss was created. The third hazard is also something to do with the human beings. It is a moral hazard, but it is human beings are not in this case thinking of actually doing something wrong. For example, people not taking care of their health or people not taking care. If you were driving and your tire was punctured and you are now on a stepney additional tire, but you didn't take care to put that tire again into condition and again started traveling the next day, and maybe unfortunately there was another puncture the next day. This is a case of the negligence by human beings and not the kind of corrupt thinking about it. The next learning should very quickly be done on fundamental and particular risk bundling, dynamic and static risk bundling, and pure and speculative risk bundlings. The fundamental risks are the risks that affect a large area, they affect a huge number of people, etc. But particular risk could be a risk that affects limited people or a single individual. Dynamic risk could be the risks that are a result of changes in economic policy, changes in maybe prices, maybe the economic conditions, maybe the preferences, consumer preferences. But a static risk could be a risk to some product that doesn't get sold for no such reason that technology has changed or consumer preferences have changed. The pure risk and speculative risk is more important because in insurance, the speculative risk cannot be insured. The understanding of pure risk would be it is a risk which will give only two outcomes, either a loss or no loss. So the easiest is cross the road. You will cross the road without an accident, or there could be some vehicle which may hit you. So these are the only two outcomes. Whereas when it comes to speculative risks, it could be betting and racing and all that, where you may put some money at risk and the money will remain the same, or the money will be lost, or you may gain also out of that particular activity. So for such risks, the insurance will not be available. Now, therefore, coming quickly to what are then the exposures? In doing all this discussion, we are coming closer to the insurance products. The exposures can be put into three types. One is exposure to persons, human beings. Other category is the exposures to property. And the third one is the liability exposures. So the personal exposures, when we say, it could be accident, it could be ill health as the first one, it could be death. But there is a third exposure also, which is an exposure of human beings living long. When they have stopped earning, they are not productive, but they continue to live. So these are the three exposures, which are personal exposures. So for the first one, the accidents and illness, it is the health insurance which will take care. For death, it will be the life insurance which will take care, and for living long, it will be the pension and annuities which will take care. The next is property exposures, and property exposures again could be of three types. The first one is accident. Yes, accidental loss because of some blast or fire in the factory. The second one would be total loss, that the fire was so much that the factory was totally lost, or the car was hit in front and back in such a way that it is not usable now. So for all these two exposures, it is going to be the products from the general insurance industry which will support these kind of exposures. And the third exposure would be something to do with loss of profits, because a particular machine catches fire and the production stops for maybe 1 week till the machine is repaired, and then the production starts again. There will be certain fixed costs falling on the head of the owner, and such fixed costs would also be covered as a consequential loss because of the first loss of the particular machine. So these are the three products available from the general insurance industry. When it comes to liability exposures, there is a product liability. Maybe we come across a number of times that people found a cockroach into the flavored milk and whatnot. Now, if such cases go into the court of law, the litigation goes on. If there is a policy being purchased from the manufacturer, which is called as the product liability policy, then whatever is the verdict and the compensation that will be declared by the court will be taken care by the insurer of this particular policy. The next one would be professional indemnity. So there are people like chartered accountants and architects and builders who are taking risk in giving advice to other people, and they may make mistakes. So here there are also directors who help the companies to work smoothly, and this is a place where the officers and directors policy is available in the market. And the third one could be a public liability, which we have seen the case of Union Carbide when Bhopal gas tragedy, because of one fault of an industry, a huge number of people died. Many of them got kind of ill effects for large number of years to come, etc. And there is a cover called as public liability insurance to take care of that. So to take care of these exposures, we have many options. One is to avoid the risk. Now, this is only a theoretical option, so we may not go for that. The next would be prevent or control the risk. Yes, this is possible. When you say prevent the risk, if there is theft happening in your compound wall, raise the level of compound wall is something that you can do. So, you have taken steps to prevent that risk, or then control the loss. The controlling the loss, the best example probably could be, and controlling and mitigation together, let us learn wearing of the helmet. So just because you are wearing helmet and driving a two-wheeler doesn't mean that you will not meet with an accident, but it shows that the kind of loss to your body or the bodily injuries will be limited and your brain will be protected. Then there is another way to handle the risk is transfer the risk, and that is where the role of insurance comes in. And of course, the last is either retain or accept the risk. That means, okay, I will live with the risk. I know there is a risk, but I do not want to buy insurance. Or this is also an area of what is called as self-insurance, that rather than giving my money to the insurance company, I may better manage it myself. So I thought that these are some of the things that were important for us to understand. And from here, we take off to the insurance. And I read out very slowly one definition, which is insurance is a social device in which a group of individuals, now they are called as insurers, transfer risk to another party, which is called as insurer, in order to combine the loss experience, which permits statistical prediction of losses and provides for payment of losses from funds contributed into bracket premiums by all the members who transferred the risk. So in short, it is a professional game. It is a game of large numbers. It is bringing in small amounts by large number of fortunate people to take care of losses of small number of unfortunate people. So this is the way the insurance works. We'll go to the next one. Certainly not a rocket science, but insurance is based on certain principles. These are the important principles: insurable interest, utmost good faith, indemnity and its corollaries as contribution and subrogation, and the proximate cause. Now, of course, this is not the forum to discuss them in details, but they are very, very interesting. And depending on your interest, you should definitely take a dip into understanding that, because that also has a bearing on the insurance litigation, etc. However, when we go to see the pictures down below, world over, the insurance is being seen in three different categories. The first category is that of life insurance, and of course, pensions along with it. The next category is called as property and casualty, or in some areas, it is also called as non life, or in some other areas, it is also called as general insurance, which is again subdivided into fire, marine, and many other miscellaneous groups such as motor insurance, engineering insurance, health insurance, agriculture insurance, and many of those. So, mostly world over, these are the two separations that have been kept till now. In India also, insurance was categorized and insurance companies were licensed differently for these two. Recently, IRDAI, the regulator, has also put in other category called as health insurance companies, but which is actually a part of indemnity-based health insurance covers, which comes under general insurance. But I'm making a mention here is that this all was till now, and as we come close to the closure of this discussion, we'll come to know that there is a big plan of the regulator in which regulator wants to change it, and it may allow what is known as a composite insurance. That means a single company selling life insurance as also the non-life insurance. Whereas the third category is called as reinsurance, and reinsurance is the insurance company buying insurance for its own protection, because insurance company also accumulates a lot of risks, and it has limited capital with it, so it also has to do the management of risk through a process called as reinsurance. So we'll go to the next one. Pictorially, yes, the life insurance protects against financial distress due to unexpected death. So it doesn't give back the dead person, but it gives sufficient funds for the family to continue making its living. The next picture is about the hospitalization. So a person gets into hospital and receives the treatment, and the medical costs are covered under the policy, which are paid by the insurance company. And the third picture showcases about the three stages: that you are young, you are earning, and you are old. So if we make our wealth allocation in such a way that when we earn the money, we also pass on some money to buy some annuities till human beings live longer, the insurance companies will keep paying back this money as pension. We go to the next slide. And this is a big picture that we must see that general insurance is very, very wide. It covers homes, computers, electronics, business, factories, construction, jewelry, cars, even animals, animal cards, crop, etc. And the bottom side of this picture is showcasing that what is known as liability insurance requires an interplay by the court of law, the insurance companies, and the insured. So it is not the payment will be done by the insurance company just like that, but it will depend on what is the verdict being given by the court that the liability claim will be paid. Next one. So this is a picture of the ecosystem of insurance as it currently appears in India. So the first green portion shows the regulator, and in India, the IRDAI, Insurance Regulatory and Development Authority of India, is the regulatory authority for insurance business. Of course, recently in 2019-20, one more regulatory authority, which is combined regulatory authority for banking, insurance, and securities markets was created in the GIFT City. It was for the IFSCs, but it is a combined regulator. The blue portions are showing the two self-regulatory bodies, which are Life Insurance Council and the General Insurance Council. Now coming to the orange portion, we have currently 24 life insurance companies licensed, 28 non-life companies licensed, 5 specific health insurance companies also being there, then one reinsurance company, GIC Re, and 12 branches of foreign reinsurance companies operate in India. So the orange portion is actually showing the players actually active into the Indian insurance market. When we see the gray portion next, these are the people who helped this particular business happen so smoothly. So there are a numerous number of agents, individual agents. Then there are 570 corporate agents and 619 brokers. The same way, there are 38 telemarketers, there are 569 insurance marketing firms, and 28 web aggregators who are in the market. Coming to the portion on the right hand side, which talks about the insurance repositories and the third party administrators. So they are 4 and 20, whereas the next is showing individual surveyors who are and the next one is about the corporate surveyors who are 188. So towards the end, it is the ombudsman system, because in spite of running a particular business in a particular professional manner, there could be some grievances. So there is insurance ombudsman, which is in almost all the states of India. Can we move to the next one? So where are we in the world operations of insurance? So we are looking at this. This is showcasing the largest insurance companies which are based on the premium, and you will see that India ranks 16th with LIC appearing on number 16. Next one, please. The same kind of ranking being done on the assets under management. We can see LIC of India at number 13. So this is about the life insurance. The next slide, please. No, the one before this. Yes. So, okay, sorry, the next one. One before. Okay, this is about the reinsurance companies in the world, and GIC Re, General Insurance Corporation of India, appears 15th in this list. But very interestingly, about 84% of the total reinsurance business actually is handled by the top 20 companies of the world. That means this market is actually saturated at the top 20, whereas there are around 200 reinsurance companies in the world, but they are all minuscule reinsurance companies. Next, please. This is again the listing of the brokers, and you can see some names. Many of you may have heard insurance brokers in India: Aon, Willis, Gallagher, and so many of them. Lockton. What is interesting to say is that many of them, these are their business volumes, are far bigger than even the insurance companies. Next one, please. So looking at now, the real problem is that insurance development and growth is seen in terms of two things: penetration and density. So insurance penetration wise, India is not doing very well, with life penetration at 3 and the general penetration at 1. General insurance penetration at 1, and the density, that is per capita insurance premium, is just